Higher gasoline and diesel prices are now draining the American economy by an extra $500 million every single day. Not monthly, not quarterly, every single day. And that number is still rising. Since February 28th, when the United States and Israel launched strikes on Iran, oil prices have surged more than 50%. The Strait of Hormuz, a narrow 21-mile-wide channel responsible for transporting nearly 1/5 of the world's crude oil and natural gas, has effectively shut down for the first time in modern history. Brent crude is now trading above $110 per barrel. Just 3 weeks ago, it was sitting near $70. But here's the part. Most people are missing the price. You see at the pump, the number you stare at every time you fill your tank. That's actually the smallest piece of what's coming. There are 4 more waves of price increases already moving toward your wallet right now. Each one larger than the last, and most people won't recognize them until it's too late to prepare. And what makes this more dangerous isn't just the economy. It's the way your own mind is processing this situation. Because right now, your brain is actively working against you, and if you don't override it, it's going to cost you. Let's start with what's already visible. Gas prices. The national average has jumped from under $3 a gallon to around 3.70. In places like California, drivers are paying over 5.30. And diesel, the fuel that powers the trucks delivering almost everything you buy, has surged roughly 36% to nearly 5.10 per gallon. Now, the average American household spends about $2,500 a year on fuel, around $50 a week. So if that suddenly increases by $10 or $15 per week, it doesn't feel catastrophic, it feels manageable, just slightly annoying. That's exactly where the mistake begins, because your brain instantly categorizes that increase as a minor inconvenience and moves on. But that classification is completely wrong, and understanding why reveals something critical about how we process financial threats. Psychologists call this mental accounting, the tendency to divide money into separate invisible buckets: gas, groceries, entertainment, savings. When one bucket suddenly expands, we don't logically rebalance everything. We react emotionally. We start cutting what feels optional. Eating out disappears. Gym memberships get cancelled. Travel plans get postponed. Investment contributions quietly stop increasing, even if we promised ourselves they would. The chief economist at the National Retail Federation confirmed this exact behaviour pattern. Gas prices spike. The first things people cut aren't necessities, they're experiences, movie theatres, restaurants, vacations. Not because those things suddenly became more expensive, but because your survival instinct reclassifies them as non-essential the moment a required expense rises. And that instinct is about to get significantly louder, because gas is only the first wave. Most people are framing this completely wrong. This isn't a single price spike, it's a chain reaction. A rolling sequence of economic shocks arriving at different times, each one stacking on top of the last. By the time the average person fully understands what's happening, most of the damage will already be done. Wave 1. You're already experiencing gas. It hit almost immediately within days. Wave 2 is landing right now. Groceries specifically. Perishable items, produce meat, dairy. Anything that relies on fast transportation. Diesel fuels the refrigerated trucks that move these goods, and with diesel up over 30%, the cost of transporting food has surged sharply. Supply chain analysts confirm that grocery stores will be the next place consumers feel price increases, after gas stations, and the less shelf-stable the product, the more exposed it is. But here's the delay: retailers don't raise prices instantly. At first, they absorb the cost, just like many did during the tariff increases last year. The problem is they've already been absorbing those previous costs. Profit margins are thin, there's almost no buffer left to absorb another shock. One economics professor warned that if elevated oil prices persist, businesses will reach a breaking point where they simply cannot absorb the cost anymore, and when that happens, prices don't rise gradually, they snap upward quickly. Wave 3 won't hit immediately, but it's already locked in, and this is the one that should genuinely concern you because it operates with a delay that makes it almost invisible until the damage is unavoidable. Fertilizer production depends heavily on fossil fuels, accounting for up to 80% of total costs. The countries directly tied to this conflict, including Iran, Qatar, Saudi Arabia, Bahrain, and the UAE, are among the largest fertilizer producers in the world, and roughly 1/3 of the global fertilizer supply moves through the same Strait of Hormuz that is currently disrupted. What that means is simple but dangerous. The food you'll be buying months from now in September and October is becoming more expensive right now, because farmers are already paying higher input costs today. This isn't a future problem, it's a delayed consequence, and by the time it shows up in grocery prices, it will be too late to adjust in advance. Most people won't even connect those higher prices back to what's happening today, which is exactly why this wave hits harder than expected. Wave 4 is already forming, and it's going to show up in airfare. Jet fuel prices have surged nearly 85% since the conflict began. Airlines across the world, from Qantas to SAS to major Indian carriers, have already started announcing fare increases, but unlike gas prices, which change daily, airline pricing operates on forward projections, meaning fuel costs are baked into tickets months in advance. Even if oil prices drop tomorrow, those higher ticket prices will remain locked in for a while. If you're planning any travel in the coming months, expect significantly higher costs, because this adjustment has already been set in motion. And then there's Wave 5, the one almost nobody's paying attention to, yet interest rates. Before this conflict, the Federal Reserve was expected to begin cutting rates this year, which would have lowered borrowing costs across mortgages, car loans and credit cards. That expectation is now effectively gone. Some economists are projecting that rate cuts may not happen until the third quarter at the earliest, and if inflation accelerates further, rates could even rise instead of fall. That changes everything underneath the surface. If you are planning to buy a home, refinance debt, or take on any major financing decision, the math has already shifted. One leading economist warned that when inflation shocks combine with geopolitical uncertainty, consumers don't just reduce spending, they freeze entirely. People delay major decisions like buying homes, cars, or making large investments, not necessarily because they can't afford them today, but because they no longer trust what they'll be able to afford tomorrow. And when millions of households all pause at the same time, the collective hesitation becomes powerful enough to slow down the entire economy. Now think about this. When you first heard that oil prices were rising because of the Iran conflict, how many of these downstream effects did your mind immediately connect? Maybe one, maybe two. That's completely normal. And that normal reaction is exactly where the risk lies. There's a well-documented concept in behavioral psychology called anchoring bias. When faced with a complex situation, your brain doesn't process every layer at once. It locks onto the most visible piece of information and uses that as a shortcut to represent the entire problem. Right now, for most people, the anchor is the number displayed at gas stations 3.7, 04.2, 0, 5.30, whatever it is in your area. That number becomes the reference point for the entire crisis. And because gas prices feel frustrating but still manageable, your brain labels the entire situation as temporary inconvenience instead of systemic risk. Meanwhile, economists are already warning that the gas spike alone could push monthly inflation close to 1%. The highest monthly jump in years. Annual inflation could approach 3%. And that's before the secondary waves, groceries, fertilizer, airfare and transportation costs ripple through the system. The International Energy Agency has already described this as the greatest global energy security challenge in history. Not a moderate disruption, not a temporary shock, the greatest challenge in history. And yet your brain is still comparing today's gas price to last month and quietly telling you that you'll manage this exact psychological pattern played out in 2022. After Russia invaded Ukraine, gas prices rose. People complained but didn't fully adjust. Then the impact spread into food, housing, services, and nearly every category of spending, inflation surged to 9%. And by the time most people understood the full scale, the damage to their purchasing power had already been done. You're not wrong for reacting this way. You're operating on the same mental wiring as everyone else. But recognizing that wiring is the first step, because once you see it, you can override it. Now let's shift to what's making people the most uneasy right now, your investments. Now let's talk about what's actually keeping people up at night, your investments. Because this is where the emotional pressure really starts to build. The S&P 500 has already dropped close to 7% from its January peak. And that alone is enough to make investors uneasy. But when you zoom out, the weakness is much broader than just one index. The Dow has just recorded 4 consecutive losing weeks, its longest losing streak in 3 years. If you're holding index funds or retirement portfolios, you've already felt that pressure. The Nasdaq, which was expected to lead growth this year, briefly slipped into correction territory, falling nearly 10% from its highs, dragged down by major tech stocks. And the Russell 2000, which tracks smaller companies more sensitive to interest rates, has officially entered correction territory, down more than 10% from its January peak. Even outside equities, the signals are just as unstable. Energy markets have been extremely volatile. Brent crude surged close to $120 per barrel before pulling back and settling around $112, its highest close since 2022. Gold, which many people assumed would act as a safe haven, spiked above $5,400 per ounce and then dropped more than 10% in a single week, marking its sharpest decline in decades. Even the traditional safety plays are no longer behaving predictably, and then there's the VIX, often referred to as Wall Street's fear gauge, which has surged from the mid-teens to above 30, signaling a rapid increase in market anxiety. When all of this hits you at once, something happens internally. Your nervous system shifts into defense mode. The amygdala, the part of your brain responsible for detecting threats, starts pushing a very simple message: get out, protect what's left, sell before it gets worse. This is loss, aversion in action. Research from Princeton shows that the pain of losing money is psychologically about twice as powerful as the pleasure of gaining the same amount. A $5,000 loss doesn't feel like a $5,000 problem. It feels like something much bigger, because your brain is wired to treat losses as threats to survival, not just numbers on a screen. But here's the critical question: what actually happens when investors act on that impulse during periods of geopolitical crisis? Historical data gives a very clear answer. An analysis by RBC Wealth Management, covering over 20 major military conflicts since World War II, found that the S&P 500 declined on average about 6% during the conflict. Another long-term study tracking 40 geopolitical events over 85 years found that markets typically drop around 1% in the first month and then gain roughly 3 to 4% over the following 6 months. The pattern is consistent. People who panic sell, lock in their losses, while those who stay invested tend to participate in the recovery. We saw this clearly in March 2020 during the pandemic crash. The market collapsed rapidly, but within just 57 days it had fully recovered and then continued rising. Many investors who sold during that drop never re-entered. They stayed on the sidelines waiting for certainty, while the recovery moved on without them. And this is where the situation becomes even more unforgiving, because the market's best days and worst days tend to cluster very close together. Miss just 10 of the best trading days over a 20-year period, and your overall returns can be cut nearly in half. Miss 20, and you may barely outperform inflation. You cannot capture the recovery if you exit during the decline. And this gap between market performance and actual investor returns is known as the behavior gap. It exists not because people lack knowledge, but because they act emotionally at exactly the wrong moments buying. When confidence is high, and selling when fear is at its peak. And this brings us to the scenario that serious economists are watching very closely. Stagflation, a combination of rising inflation and slowing economic growth happening at the same time. This is one of the most difficult environments for any economy to navigate, because the tools used to fix one problem worsen the other. If central banks raise interest rates to fight inflation, they slow down economic growth. If they lower rates to stimulate growth, they risk making inflation worse. There's no clean solution. And right now, policymakers are already facing that dilemma. The Federal Reserve has paused rate changes because the uncertainty created by this conflict has made the path forward extremely unstable. If the disruption continues and oil supply remains constrained, some analysts believe crude prices could climb toward $130 per barrel. At that level, the impact is no longer limited to inconvenience. It starts causing structural damage to household budgets, consumer spending and corporate earnings, and history shows a very clear pattern. Major oil shocks are often followed by recessions. The 1973 oil embargo triggered a prolonged economic contraction. The 1979 Iranian Revolution doubled oil prices and led to another downturn. The 2008 oil spike came just before the global financial crisis. These events are not identical, but the pattern is consistent enough that many economists view oil shocks as one of the most reliable triggers for stagflationary conditions. And the current disruption with production across major oil-producing nations dropping significantly is already being described as one of the largest supply shocks in modern history. That's not a phrase that gets used lightly, and it should change how seriously you interpret what's happening, regardless of what the price at your local gas station looks like today. And even when this situation eventually stabilizes, relief won't arrive immediately. There's a well-known phenomenon in economics called the rockets and feathers effect. Prices rise rapidly like a rocket, when costs increase but fall slowly like a feather when those costs decline. We've seen this before. After previous energy shocks, prices spiked within days but took months to normalize. Even if supply resumes quickly, you're still looking at weeks for production to ramp back up, and months for prices to gradually ease while the ripple effects continue moving through the system, which means even in a best-case scenario, elevated costs are going to linger longer than most people expect. Now take a breath, because this is the point where most people feel overwhelmed, and this is exactly where your decisions start to matter the most. Now let's shift to what you can actually control, because the difference between people who come out of economic shock stronger and those who come out weaker has very little to do with what happened, and almost everything to do with what they did while it was happening. The first and most important move right now is simple, but psychologically difficult. Do not panic, sell your investments. Every instinct during uncertainty pushes you towards safety, toward cash, toward pulling back. But multiple studies across decades of market data show that this is one of the most expensive mistakes investors consistently make during periods of crisis. One financial planner explained it clearly: wars may last years, but your investment horizon likely spans decades. Moving entirely to cash doesn't eliminate risk. It replaces market risk with inflation risk and opportunity cost. There is no risk-free position sitting on the sidelines. While inflation erodes your purchasing power is still a loss, just a quieter one. Next, you need to pressure test your emergency fund. Most financial advisors recommend holding between 6 to 12 months of living expenses in a liquid account, preferably something like a high-yield savings account. If your buffer is thin, this is the moment to strengthen it. Not because the worst case is guaranteed, but because having that cushion changes how you behave under pressure. When you know you have financial runway, you don't make reactive decisions. You don't panic, you don't rush. You don't liquidate assets at the worst possible time. That stability is not just financial, it's psychological. Think of your emergency fund not as idle money, but as insurance against your own fear response. Then take a hard look at your spending before the next waves fully arrive. Gas has already hit, groceries are rising, airfare is coming, and borrowing costs are staying elevated. If you wait until all of these pressures show up simultaneously, you'll be forced into reactive decisions instead of controlled adjustments. Cut discretionary spending now before it becomes necessary. Redirect those savings toward building resilience, whether that's increasing your cash buffer, reducing debt, or maintaining your investment contributions. These are small moves, but timing is what gives them power. If you're already investing consistently, keep going. This will feel counterintuitive because investing into a falling market feels wrong emotionally. But this is exactly where long-term advantage is built. When you invest a fixed amount regularly, you automatically buy more when prices are lower and less when prices are higher, lowering your average cost over time. This is dollar cost averaging, and it works because of volatility, not in spite of it. The uncertainty that feels uncomfortable right now is quietly creating better entry points for future returns. Many of the strongest long-term gains historically have come from investments made during periods of maximum uncertainty, not during stability. Now map your personal exposure to energy prices, because this crisis doesn't impact everyone equally. If you rely heavily on commuting, the economics of fuel efficiency matter more than they did before. If you're carrying high interest debt, especially on credit cards, this is the time to aggressively reduce it, because borrowing costs are unlikely to drop anytime soon. If you run a business that depends on transportation or logistics, your cost structure has already changed. Fuel surcharges, shipping expenses, supplier pricing. All of it is shifting, and waiting too long to adapt can compress margins quickly. Renegotiating contracts, optimizing routes, or sourcing closer alternatives now can create a meaningful advantage later. And here's something most people underestimate during periods like this. It's not intelligence or income that determines who comes out ahead. It's response time, data from past economic disruptions, whether it was the 1973 oil crisis, the 2008 financial collapse, the 2020 pandemic, or the 2022 inflation surge shows a consistent pattern. The households that performed best were not necessarily the highest earners, they were the fastest to adjust. They recognized early signals and made small disciplined changes before the full impact arrived, reducing unnecessary spending, strengthening savings, maintaining investments, and lowering debt. None of these actions are dramatic, none of them are exciting, and none of them are visible on social media. But over a period of 6 to 12 months, those small, early adjustments compound into a significant financial advantage. Not because each move is large, but because they started before the pressure forced them to act. Right, now, your window is still open. You're aware, you're thinking about your finances, you're analysing your exposure. Most people won't reach this point until the 4th or 5th wave has already impacted their bank account. And by then, proactive decisions turn into reactive survival. Feeling anxious about this situation is not a flaw, it's a signal. It means you're paying attention. The mistake isn't feeling the fear. The mistake is allowing that fear to make your decisions for you. Panic selling, freezing, or ignoring the situation entirely. Those are instinctive reactions, but they are exactly the wrong ones in this environment. The correct response is controlled and deliberate. Review your budget, strengthen your emergency fund, continue investing, understand your exposure, and once those actions are taken, step back from the constant noise, because the headlines are designed to amplify fear, not guide strategy. You don't need more fear, you need clarity, and you already have it. You've navigated uncertainty before, and you will navigate this as well. The real question isn't what happens next, it's how you respond to it, and that decision is still completely in your control. If this shifted how you're thinking about the next few months, then take a moment and decide your first move, because the earlier you act, the more options you keep. And remember, this situation is still unfolding, which means your opportunity to stay ahead of it hasn't closed yet.